So what happened is in 2007, 2008, going into the financial crisis, the size of debt for the U.S. economy was $9 trillion. We had borrowed $9 trillion, issued treasury bonds against that to run the economy. The ratio of that debt to the size of the economy was about 60%. Today, it's 120%. So the amount of debt that we need to run the economy as it is twice that it was before the financial crisis. And in addition to that, as I said, the Fed's book is still about the size that the treasury market was in the beginning of the financial crisis. It is astounding how much the Fed has participated in allowing debt to become inflated and having it on their books.
Hello, welcome to the Wiggin Sessions. I'm your host, Addison Wiggin. My guest today is out for revenge. Nomi Prins is a best-selling author, PhD, investigative journalist, and also a former managing director at Goldman Sachs. She's talking to us today about something that she wants to warn investors about, that it's a similar crisis that wiped out her mother's savings back in the early 2000s. So she has a strong concern. We'll talk about that in a second. First of all, I want to welcome Nomi back. She's been on the show a number of times. So welcome back, Nomi.
Thank you so much, Addison. Thank you for having me on today.
It's good to see you again.
You too.
Let's talk about the last time you were on the show. We talked about what you call the great distortion, and it's a big disconnect between the financial markets and the economy. That has gotten greater, in my opinion, because of the inflation that we've seen manifest itself mostly in 2022. Maybe give us a wrap up of what you see going on with the great distortion right now.
Yeah, thanks. That's a great question, because one of the chapters in my book, Permanent Distortion, which is coming out shortly, was about inflation. And when I wrote the chapter, inflation was just kind of picking up, and the Fed considered it transitory, which of course it isn't and wasn't, and sort of didn't notice what was really happening around them. And so now we're in this situation where there is a period of heightened inflation, and it's particularly noticeable and in the energy sector. And the energy sector, of course, also fuels everything. So it fuels everything in the economy, whether you look at gas prices or natural gas prices or anything that really powers our world. It's a significant sector, and there's been significant inflation in it, as there has been in food, as there's been in fertilizer, as has been in a number of the things that we need and use. And so that inflation, which has been hovering over 8% in the months in the past several months on an annual basis, as the Fed looks at it, is high, and it's high historically. But on the same token, what the Fed's trying to do is effectively walk it back with monetary policy. And this is where the great distortion really comes into play, because the Fed for years has inflated the markets with cheap money, with a balance sheet now. Their books are about $9 trillion worth of debt that they've bought. Other central banks around the world have done the same, to the tune of tens of trillions of dollars. And now they're like, well, food and fuel's up, so we're going to try and fight inflation in general, not having noticed what we've done to inflate and distort markets relative to the real economy. But ultimately, they can't. And as a result, they're creating more of a distortion between the markets and the real economy, because the real economy has to contend with real inflation, and the Fed can't do anything about it, but they can hurt other parts of the economy that are already starting to slow. And so that distortion, that disconnect, like you said, and you're noticing it getting even larger, it absolutely is now.
As we are talking, the Fed had a couple of days ago raised rates for the fifth time this year. This was a 0.75 point raise. And so we're starting to see interest rates impact things like the housing market and people's ability to buy new homes, finance cars. It's starting to really impact the real economy at a time where when I remember when I was watching the Dow chart after the last rate hike, and it was whipsawing. The financial markets were way down, and then they were way up. And then I believe they closed about even, but that is an indication of the distortion that you're talking about, because the financial markets are trading based on what they see the Fed doing, but the real impact in the real economy is on people's ability to finance their own lives. And then you're pointing out, this is the primary thing we want to talk about today, is what you call Enron 2.0, which is an energy crisis that is spurred on by this wave of inflation. And the way inflation works, the damage is done, even if the Fed were able to rein it in. The impact on the energy markets, for example, the damage is already done, and we're going to see that for a number of months to come, at least. That is, if they can get inflation under control, which we both think they can.
Right. We agree. Absolutely.
So why don't we get into the energy markets then, and explain the phrase Enron 2.0. What do you mean by that?
So this goes back 2 decades. So long story short, bringing the past forward, Enron, first time around, was a tremendously big scandal in the corporate markets on the Wall Street side. It brought down a company or bankrupted a company that had basically cooked its books for a number of reasons. It also unfolded around that same period that large other companies like WorldCom, Tyco also had cooked their books in similar ways. And so the result was a just corporate rout at the heart of the financial and corporate system that had just major ramifications. And Enron was sort of the start of that. Now, the reason I call this Enron 2.0 right now is because let's think back about what Enron was supposed to be doing and what they did instead. They were supposed to be an energy company, but they went way beyond really supplying power and doing energy-related activities and services to get involved with all sorts of other aspects of the financial market, of assets that really didn't belong in energy, and really extending themselves way beyond anything that was in their lane, and also had any sort of upside or profitability at the time. And so one of the things that's happening now is because of the energy crisis we have again, as we did 20 years ago or so when Enron went bankrupt and all this fraud, it's back. Now, the energy crisis is back for different reasons. There are supply chain related reasons. There's reasons because of what's happening between Russia and the Ukraine. There's reasons because we came out of a pandemic and we didn't prepare for what would happen to the economy after it was all shut down. There's many reasons why energy prices are high right now. And that was something that was happening again at the time. So there are companies in the crux of that, in the crossroads of this again, that have overextended themselves, only this time. And why it's worse, and why I call it Enron 2.0, I should really call it Enron 25, but it's this other sort of derivation of that, is that we had all this cheap money this time underlying all of this overextension and all this leverage related to the energy sector. And so as a result, there's a lot of companies that we're going to see during this crisis as it unfolds really go belly up or have massive problems. We could see fraud coming up. We could see a number of things happening. And as a result, the impact of Enron 2.0 is going to be larger, I think, than what we saw back in that crisis period back nearly 2 decades ago. And I think it's important. It's really important for anybody invested in the market or who pays electricity bills or uses power, which is pretty much everybody, to understand what's unfolding here in this energy crisis period and how it's unfolding and what they can do about it, how they can actually turn it into an opportunity as well.
One of the things that has happened during each crisis, going way back, but in the amount of time that I've been covering the markets, 2000, 2008, 2012 through 15, every time there's some kind of crisis in the markets, the Fed has to lower rates. They have to put more cheap money into the market. That creates an interesting scenario for them. Each time that they did it in the past 4 crises, they were fighting what they called they were afraid of anyway, which was deflation. Mm-hmm. Now they're in this tightening mode because they want to fight inflation. If an energy crisis unfolds, like you say, what does the Fed do? What do central banks do in a scenario where they're trying to fight inflation at the same time that there's a crisis that has to be dealt with in the real economy?
Yeah, and that's the what I call $150 trillion question, and there's a reason why that number is so big, because we're also engaged in a long-term energy sort of transition, I'll say, and right now the energy crisis is predicated on the fact that we have too much demand for the amount of supply for multiple factors of fossil fuel energy, oil, of natural gas, of coal, of, there's an interesting story that's developing here on firewood, and burning that for people to basically keep themselves warm in the winter. And so that's happening on one side. That's pushing the price of those commodities up and related commodities up. And then on the other side, we've got the Fed saying, hey, we're going to fight all this. Now, the Fed ignore the fact that they inflated as a result of crises, as a result of Wall Street needed them to, multiple different reasons over the years, their books and the markets, and they distorted that relationship between the markets and the real economy. So now it's as if they are trying to fight two fires at the same time in completely opposite areas, one of which is related to housing prices or interest rates or borrowing costs, which they actually can do something about because they can raise them, and that's going to hurt people and disable them from borrowing, whether it's to pay their mortgages, whether it's for cars, etc. And there's an impact that can have. But the bigger part of inflation is something that the Fed and central banks cannot fight, because they cannot produce oil, they cannot produce natural gas, they cannot farm more food, they cannot create more fertilizer to enhance crops. And so there's so many things about inflation today that they have zero impact on. And yet they're caught in this spot where they inflated the market side of things by so much, so fast, and in so many ways, and in such an unchecked manner, that they're kind of acting as if they can control every part of inflation beyond that, and they absolutely can't. And this is why we're also in more of a crisis period now, because they say that they can, and the mainstream media is accepting the fact that, okay, well, Powell said he needs to fight inflation, the Fed's going to raise rates, we got to take some pain, that's what Powell said. And in the meantime, growth has slowed down. GDP has been zero for the last 2 quarters in the United States, which is a recession. It's probably going to come in close to zero again. We're facing recession. We're facing high costs of energy and food anyway. And the Fed's making it harder for people to basically finance their own real economy, their own homes, their own cars, as you said, and those sorts of things. So it's creating an absolutely worse scenario right now for the economy relative to the markets. And at some point, what the Fed is going to have to do, and it was interesting because when they raised rates for the third time by 75 basis points, they kind of opened the door for this. They are going to have to somehow find language and some kind of way of backing off from this rate hike mode, hike rates by less, somehow back off of that rate hike gas, because they're going to have to recognize that they can't impact inflation that they have no control over. They're not going to say that, but they're going to have to do that, because the economies are going to slow down, because energy costs are going to eat into individuals' home budgets and also into corporations, and things are going to close, and it's going to have to be something that the Fed has to step back from and take a look at. And I think at some point they will acknowledge that, and they started to do that. They started to sort of, put out some language in that direction when they raised rates by 75 basis points for the third time.
What can they do? So I know that you did your PhD on central banks. So take us inside a central bank. What are they thinking? What can they do if there's still this inflation monster out there and we're facing a financial crisis at the same time? One phrase that I've heard repeatedly is that they're out of bullets. They can't do anything else. That really all they can do is go do what they did in the bailout period, which is go into the markets and start buying up equities well, they didn't buy equities until the pandemic, but buy up assets to support different sectors of the market. But it seems untenable in an inflationary environment. It doesn't seem like the scenario supports an activist Fed.
It doesn't at the moment because the Fed is still trying to, again, fight these two forms of inflation in market, in assets, and in finances, and pretend to fight this real other inflation, which is in fuel and food and fertilizer prices. And they absolutely can't do both. So what's going to have to happen is they will ultimately have to recognize that inflation, for the second reason, for the energy side of the equation, is going to remain high no matter what they do. And all that they're going to do in the meantime, by raising rates as quickly as they have for a continued period of time, is crush the real economy. So what they're going to have to do is go back to that arsenal of tools, which is the only thing they actually know how to do to help the economy once they see this, once they admit this, and basically go back and like you said, they're going to have to go in and buy assets again. And the reason I think this as well is because with all these rate hikes that we've seen, one thing has remained pretty constant, and that is the size of the Fed's book. Now, the Fed has said we're going to do quantitative tightening. They have this whole program that they've lined up since June in terms of how much they're going to let roll off of their book. So they're not going to sell those bonds into the markets because they know that will create even more havoc, and certainly more havoc for credit, certainly more havoc for the relationship between Wall Street and corporations. And so they're letting it kind of roll off slowly. But that slowness is actually an indication that they're trying to still keep that old policy engaged, because right now, the Fed's book is still close to $8.8 trillion. At its height, it was just under 9. It has barely touched the debt that it has. And here's another really, really scary stat I just looked at today, Addison, and you will appreciate this, because none of us like to have the economy run on so much debt that it can't sustain itself, which is where we're at right now. So what happened is in 2007, 2008, going into the financial crisis, the size of debt for the U.S. economy was $9 trillion. We had borrowed $9 trillion, issued treasury bonds against that to run the economy. The ratio of that debt to the size of the economy was about 60%. Today, it's 120%. So the amount of debt that we need to run the economy as it is twice that it was before the financial crisis. And in addition to that, as I said, the Fed's book is still about the size that the treasury market was in the beginning of the financial crisis. It is astounding how much the Fed has participated in allowing debt to become inflated and having it on their books. So at the end of the day, what are they going to do? They're going to let these little dribbles of roll-offs happen because they said they would, and they would look really bad politically if they stopped it. But at some point, they're going to go in and they're going to buy bonds. And that's going to ultimately push people back into the stock market. There's going to be sector choices. It's not going to be necessarily a blanket form of QE, but it's going to manifest in certain sectors. And I think one of the main sectors in play as all of this unfolds is the energy sector, because again, that's the sector they can't control, but they can see what the fallout is when there's energy crises on the global economy, on the U.S. domestic economy.
I want to ask you a question about Japan, because we, in a chapter that Bill and I wrote in the 2000s, right after Japan was going through their own kind of debt crises, the bank was involved in acquiring assets, and they were doing similar things. And we kind of followed their playbook. Their debt to GDP ratio is I think it's like 180% right now.
Yeah, it's astronomical. It's more actually. Yeah.
So, I mean, Japan has in some ways proven that you can run high debt to GDP ratios for an extended period of time. But then there's not a lot of opportunities in the real economy to grow because the debt is like crowding out all other resources. How do you compare like what you just mentioning that 60% to 120%, and then we could add another 60% and we'd be where Japan is? How do you compare like Japan's trajectory to the scenario that we're facing right now?
Right. So Japan has basically had decades of close to no growth. So even though it's continued to issue debt to basically balance its economy and not in a very good way, right? So it's still always issuing more debt than the size of its economy. And that's why it has such a high debt to GDP ratio. And it's called upon time after time again, and since the 90s, its central bank to basically buy that debt in order to finance the Japanese economy. And so it's never dug itself out from a real like solid economic growth where people actually, have a sense of the country moving forward economically. It's never really been able to do that. So kind of when the financial crisis hit and then when the pandemic hit, the Bank of Japan just did what it's been doing for a long time, but it did it in like a steroid sort of way because now the Fed was doing it too. And so the minute the Fed jumped in and started doing what Japan had been doing for years, and Ben Bernanke along the way said, no, I'm not doing what Japan's doing, even though we're buying bonds the same way Japan is. We're creating money out of nowhere. We're fabricating currency, and it's not coming from a productive economy. It's coming from electronic, sort of points on a computer. And so all of that doesn't allow the real economy to function like it should, with like proper investment, proper production, growth. Solid levels of inflation aren't necessarily bad. What's happened now is we've had spiked up inflation, but to basically have a nice normal sense of growth, the Fed has basically taken that out of our economy the same way that the Bank of Japan has taken it out of the Japanese economy, but they can't go backwards either. And this is one of the reasons I see these central banks keeping their sort of foot into, straddling the sort of divide here, maintaining big books, buying bonds, excuse me, and yeah, they're raising rates right now. Bank of Japan isn't, the Fed is, in order to contain inflation that again they can't really contain, and in the process actually damage the economy. That they allegedly were buying bonds to help. It's a kind of psychotic thing that's going on right now with respect to how the Fed is behaving. It's probably more of a psychological study at this point than an economic one, because it doesn't make economic sense.
Do you see decades of low to no growth for the U.S. too?
Collectively,
turn Japanese.
But Addison, if we just take a look at what's happened since all this money was dumped in since the pandemic, yes, we've had certain prices spike up because we've had supply chain issues and political issues and all the things we were talking about before, and particularly in energy and food. But we also have had all of this extra sort of help, and we still only have allegedly to help the economy. And we still have an economy that's negative right now. That obviously was very negative during the pandemic, but it shut down. So let's just consider that sort of just a dark period. But even before that, our economy in the U.S. was barely growing on average at 0 to 1% on average since before the financial crisis. So we have not seen any real benefit from whatever the Fed has done one way or the other in the real economy. And so this is a problem. And again, it's a bigger problem now with the sort of acceleration of rate hikes, especially when those aren't helping some of the main core factors of inflation, which relate to energy and food and fuel.
Let's return to the energy crisis. I'm curious. I've been covering sort of green energy. I know that you've been a proponent of green energy technologies, and you have a portfolio that picks the companies that you think are not frauds and are actually doing good work. To what extent are the policies that are being advanced, like I think of Germany shutting down their nuke plants, and then they have this crisis with the natural gas coming out of Russia, and then policies of not allowing permits for roads in Alaska. Like there's a concerted effort to shut down fossil fuels and to promote green technology. To what extent is that contributing to inflation in the energy markets?
That's an excellent question. What we're seeing now is two different things happening in the energy markets. One is that we run on fossil fuel, right? I mean, that's the reality. The majority of energy that's used in homes for the electricity that helps to basically heat or cool our locations of business, our locations of living, all of that predominantly is still based on fossil fuels, on some combination of oil, and some combination of natural gas. Now there's more coal coming into play because a lot of coal plants were shut down, and now all of a sudden they're being brought back online because there's a necessity there for people to heat their homes, especially with winter coming, and to use that energy. On the other side of that divide, and this is where I was a proponent and still am, a proponent of the better companies, the ones that are viable companies in green energy, is that we still want to evolve so that we can use wind, we can use solar, we can power our vehicles, et cetera, with a different kind of sustainable effort and source. But we don't have to choose between the two. I believe that we can understand that fossil fuels are a reality and a necessity and a practicality, and sustainable methods and technologies are evolving as well. And so the question here is, did the governments of these countries go too far too fast with requiring certain green technologies and certain renewable energies to basically take too much of the place of fossil fuels too quickly, such that when we did come up to an emergency situation, a crisis situation like we have now, that sort of zeal, that speed actually made it worse. And it's a really subtle distinction, but it's so super important, because what's going on right now, and I was just in Europe, I was just in the UK for a couple of weeks, and I can tell you, Addison, that everyone is concerned. From the pubs to the individuals to the bigger companies to food production, they're all concerned about the cost of energy. Why? Because 40% of the UK's energy and electricity comes from natural gas. And because even though a lot of that natural gas doesn't come from Russia, the fact that there are tensions along the pipelines from Russia to Europe makes its way into those electricity bills. It makes it into the people who are very much concerned. And that's why, they're basically gathering up firewood and sort of sort of jiggering up coal plants in order to basically accommodate that. So the timing of that green versus fossil fuel transition is very, very key. And you can't negate the use of fossil fuels when they're being needed by our global economy in order to 100% go too quickly into the green side. So the issue is here that's what governments are doing. That's one of the reasons why Germany, as you mentioned, is basically kind of having to bring its nuclear power plants back online, because they need a power source. So I think ultimately this is where our world is at right now. We're in this crazy transition period, but we're also in a necessity, practicality, reliance on fossil fuels. And we also, do have an evolution going on the sustainable side at the same time. And I think governments were trying to just too much rely on one side.
Yeah, the way I've been thinking about it is that they're trying to just flip a switch, but the technology on the green side is not nearly as robust enough to replace, like natural gas. In California, they're banning new houses with natural gas, or it's been proposed. I don't know if it's been accepted, but like they're trying to actually manufacture a market for green tech that isn't developed yet. That's the way I feel it's going on. I was just the last time I spoke to you, I was about to go to Greenland and look at the melting glaciers, because that's one of the biggest on the the environmental side, is that sea level is rising because the glaciers are melting faster. And we talked to a bunch of scientists and stuff. And so it does seem like a concern, but at the same time, there's no real replacement for the energy grid that we have in place now. The policies that are in place are actually creating, in some ways, this is the way I see it, and you can correct me if I'm wrong, but they're creating a crisis that doesn't need to be there. There is inflation. There's inflation in the energy markets, which is part of just the inflationary environment. But these policies are actually making a crisis out of something that could have been managed more effectively if it wasn't such a political hotbed.
Yeah, no, that's absolutely right. And to an extent, in the U.S. at the moment, we haven't really felt the brunt of the energy crisis that is really gripping Europe and the UK, especially into the winter. But natural gas, oil, it all trades on a global market. And one of the things that we've seen in particular this year is that natural gas, oil, lumber, things that are needed basically to source energy or to power businesses and homes, etc., are in crisis, and those prices therefore have risen. And the companies that are involved have done quite well as a result, because they're basically supplying what is very much demanded. And so I agree that that the speed of wanting to flip that switch. And it's funny, Addison, I just actually wrote to one of my readers about that very thing, and I use that very term. That this was a situation where they wanted to sort of flip a switch, and you can't do that if you don't have the replacement ready. You have to still be able to plenish, especially when there's a crisis, especially when we've seen supply demand, distortions happen before this winter. Even before Russia invaded Ukraine, even before all of this issue that's going on in Europe, even before that, we were seeing this crisis unfolding. And that's when at least there should have been, sort of more renewed focus on the necessities of today. And that wasn't happening. So it is a problem. It's created, as you say, it's created a crisis out of something that might have been a mini crisis. It is still happening, but it's made it a whole lot worse because we're in it right now.
Yeah,
and you can't just you can't just flip a switch actually like on a coal mine. Like if you shut these things down, it takes a minute, more than a minute to power things back up. And as a result of shutting down some of these power sources in the period of wanting to transition too quickly to other sources of power on the renewable side, we have this gaping hole. And the fact that you have a gaping hole in that supply for what we need right now in terms of energy squeezes the prices up by more, and that creates more of a crisis.
So just to kind of summarize where we are in the conversation right now, we have a crisis. Fed prints money to try to deal with the crisis, and they drop interest rates. Now they're fighting inflation. So when we get this distortion and the energy markets kind of take off in inflation, and the Fed can't really do anything about it, then you have a sort of powerless Fed to try to regulate the economy. So it actually exacerbates the crisis rather than helping to fix it. I know that in some of your writings, you're kind of looking at a date in the future. There's an event coming up that you think will be a watershed moment for the crisis this winter, because everyone's looking at Europe because of the crisis in Russia and Ukraine. But as you say, the markets are global. So this could be a massive problem in a very short amount of time from now.
No, that's right. And that's really around the corner. And everything, because it is interrelated, because we are global and because the energy crisis is real. And what the Fed can or cannot do or will not say into this date is something that is really going to come to a head. And I think that there's ways to get out, at least in front of that, from an investment standpoint, and also to look at what we were talking about, this whole situation of what's needed right now from a current energy and a fossil fuel-based energy perspective, what's happening over the transition in a more normally unfolding time line, and how we can really look at that picture holistically rather than sort of on a moment by moment basis. But I think that the trigger for looking at that from the standpoint of that entire energy crisis situation, the kinds of distortions that's going to unleash is really around the corner.
I believe I was told that you're hosting a webinar to talk specifically about some of the investments that people can get into. I believe it's on September 28th, which is not that long from now. Can you tell us a little bit about that? Because normally in the Wiggin sessions, we don't give away stock picks or anything. That's usually reserved for paying subscribers. Mm-hmm. But the webinar gives you a chance to kind of go into Enron 2.0 a little bit deeper, and then talk about the actual companies that are that you're looking at that provide an opportunity leading into the crisis. And generally, that's what happens in a crisis anyway. The Chinese have that phrase, like every crisis is an opportunity. Right. Generally, that happens. There's somebody that foresees the crisis developing, and then goes into high gear and figures out a solution for it. And those are the companies that generally do better.
That's right.
When the crisis arrives. Maybe tell us a little bit about the webinar that you have planned.
Yeah, no, thank you, Addison. So this webinar is on September 28th. It's at 8 p.m. ET, and it's about Enron 2.0. So I really want to explain to everyone watching exactly why this moment in particular is presenting a really large energy and corporate crisis, but also why, again, that presents opportunity. Why I haven't seen anything like this, and I've been following this stuff for decades. And I worked at Goldman when Enron happened. Enron was actually one of our clients. They actually used some of the research that my team developed in some of the things that they were doing that weren't energy related. So this goes really way back for me. And I've been watching that evolution in the energy markets for a very long time. You and I haven't talked about it as much as some of the other things I watch, but it's been a big through line for me. And so one of the things I want to do is explain that in this webinar and why we're at this moment, and what the downsides can be and the crisis is going to unleash, and also, of course, what the opportunities are. And I've developed this other strategy, and this also relates back to what I was doing at Goldman back there, and really what I've been looking at over the years, but haven't produced yet. And it's a strategy that doesn't look at one pick at a time, because we are in such volatile moments, and because this is sort of crisis meets transition meets, Fed incompetence, all happening at the same time and all unfolding over the next months to a year or two, I think. And so the strategy takes into account time. And that's something very different. So as a result, it's not, just get this stock, just do this next month, just do that next month. After that, it's actually looking at the entire sort of puzzle that's the energy sector and the energy crisis, given this really sort of historic moment of all these three things colliding. And a strategy that I'm going to explain on that webinar in more detail that allows investors to consider the timing factor of everything as part of the strategy. And I haven't done this before, but I think it's really important for this moment. I don't think a moment presented itself with so many competing major distortive events happening as really now since I left Wall Street.
When we began this conversation, I mentioned that you were out for revenge. You're seeing a scenario bubble up that really impacted your mother. I wonder, it sounds like part of your motivation and your passion for bringing these ideas to light is you've lived through it. You've seen it happen. You've seen what happens when people are unprepared and rely on Wall Street to get them through or whatnot. It sounds like your mother's savings were wiped out. I don't know if you feel like talking about that, but it does help explain why you're passionate about helping investors, people that are watching this program, what you see and what they can do to either take advantage of the opportunities or simply just protect themselves.
Yeah, no, I appreciate the question, Addison. So my mom is, first off, an incredibly intelligent woman. So I have an amazingly close relationship with her. We are super tight. We have been throughout my life. And at the time that Enron was impacting the markets and that fraud that was ultimately connected to badly timed and badly overextended practices on their part was something that ultimately was a contagion at the heart of a lot of corporate America, and how Wall Street and corporate America connected at the time. They sort of helped each other to create a real sort of cancer at the center of Wall Street and corporate America financially. And of course, you had brokers at the time, and I'm going to try to cut this long story short, but basically, because it is difficult. So you had brokers at the time who were trying to tell retirees where they should invest in this moment, and they were talking their own book. They were basically trying to get people in and say, yeah, WorldCom's going to do fine, no problem. Yeah, it's down by like 90%, no problem. It's going to turn around tomorrow. And they had all this information that was indicative of the fact that wasn't going to happen. But they were so convincing to their customers that, in the case of my mom, who again really super smart, she just listened. She trusted her broker, as many people do. And it wasn't until Enron sort of unleashed this other set of just corporate flameouts that she told me. about this story, that she told me that, literally more than half of her retirement savings was wiped out because she trusted her broker, and not blindly. She had the analysis, she had everything given to her. And I was like, Mom, I worked on Wall Street. Like, why didn't you ask me? And this guy was so convincing, not just to my mom, but lots of other people around that time, that she didn't think she needed to, and a lot of people didn't. And so for me, because I do that for a living, and I've watched the markets for so many decades, it really just hit home. And so this strategy, this moment, this energy price, it all brings that up. And what I don't want to do is have anybody else basically go through that experience. My mom's doing fine now. We built her back up. I mean, but it was really painful to see how badly that had affected her. And I just don't want that to happen to anybody else.
Well, tell me again about the webinar so people can sign up and learn about your strategy.
So it's on September 28th, which is Wednesday, and it is at 8 p.m. Eastern time. It's I'll tell you right now, it's a really I expect it to be a really eye-opening experience for anybody who tunes in. There's a lot of thinking I've been doing to get to that point, to get to the product, to get to that webinar. So I really urge everyone to really tune in and participate, because this is a lot of my analysis, my experience. Like you said, my passion, my focus is really going in here.
Okay, we'll be providing information for people to sign up.
Thank
and
you.
I look forward to the next time.
Me too.
As long as we still have energy at that point.